So picture this. It's 2026, and the biggest space company in the world just spent 60% of its budget on things that are never going to leave the ground.
Right, which is just, I mean, it's wild to even think about.
It's completely wild. Today we are looking at the SpaceX initial public offering, ticker symbol SPCX. But we aren't just doing a standard recap of a stock ticker today.
No, definitely not.
We are doing a modern money intelligence, or MMI, strategic analysis of this whole post-listing landscape. Because when the dust finally settled on June 12th, SpaceX had raised $75 billion.
Yeah, totally shattering the previous world record set by Saudi Aramco.
Exactly, and they hit a day one market cap of $2.11 trillion. I mean, trillion with a T.
Which is why we were treating this valuation as like a tectonic shift in global capital. If you look at the sources for this deep dive, ranging from the official S1 SEC filings to, independent probability models from Morningstar and structural capital market analyses, they reveal a company that's operating in two completely different realities at the same time.
Okay, let's unpack this, because that detail about the budget is the most jarring revelation in the entire S1 filing.
Oh, for sure. On one hand, you have humanity's most ambitious physical infrastructure project, and on the other, this unprecedented financial anomaly.
Right, so if you look at their capital expenditures for 2025, total spending was roughly $20.7 billion. But about $12.7 billion of that was directed entirely to their artificial intelligence division.
Yeah.
Which means SpaceX isn't really just a space company anymore, right? I mean, they are an AI infrastructure company wearing a rocket suit.
That pivot is basically the core of the bull case here. And it was heavily accelerated by the acquisition of XAI earlier in the year.
Right.
What the sources detail is a company trying to just aggressively solve the physical bottlenecks of AI, specifically power and compute.
So think of SpaceX not as a delivery service for satellites, but as a company trying to own the entire physical nervous system of future computing, from the power source right down to the brain.
That's a great analogy. And you see this in their terrestrial flagship data centers, Colossus and Colossus D2. They built the first gigawatt-scale AI training cluster in 122 days.
Which is incredibly fast.
And the second one in 91 days. I mean, the industry benchmark to bring a greenfield data center of that scale online from scratch is roughly 2 years.
2 years. And 91 days is literally a single financial quarter. But they aren't just building the data centers. The S1 outlines this initiative called Terafab, which is a collaboration with Tesla and Intel.
Right, the Terafab project.
Yeah, and the goal is to vertically integrate chip manufacturing to produce 1 terawatt of compute hardware a year. They are making absolutely sure they never get bottlenecked by third-party silicon suppliers.
And what's fascinating here is that this terrestrial build-out is actually just phase one.
Right.
The grand vision that's driving these multi-trillion-dollar projections, it relies entirely on the Starship V3 program.
Okay, so how does the rocket tie back into the AI chips?
Well, their stated objective is to reduce the cost of reaching orbit by 99%.
Yeah.
We are talking about dropping the historical average cost from like $18,500 per kilogram down to a potential $67 per kilogram.
Wait, really? $67?
Yeah, if Starship V3 works exactly as planned.
Okay, so if you connect the dots between the heavy investment in AI and that drastic reduction in payload costs, the end game isn't about launching standard communications satellites anymore.
Exactly.
It's about moving the actual data centers into orbit. I mean, if you look at the power constraints on our grid here on Earth, the bottleneck for artificial general intelligence, or AGI, isn't just silicon anymore, it's electricity.
Terrestrial power grids simply cannot sustain the gigawatt demands of AGI without collapsing. They just can't.
Right.
So SpaceX wants to bypass the Earth's power grid entirely. They are planning to launch orbital AI compute satellites that function as essentially space-based server farms.
Which is just a massive conceptual leap.
Yeah, these satellites would draw unfiltered fusion energy directly from the sun, process the complex AI models up in orbit, and then beam the result back down to Earth via the global Starlink network.
Okay, but looking at the physics of this, I have to push back on how practical it actually is, because space is an incredibly harsh environment.
Oh, absolutely.
Yes, it's cold, but it's a vacuum. Convection doesn't work up there. You can't just, run a massive fan to cool down a server rack like you do in a data center in Memphis.
No, you definitely can't.
Heat has nowhere to dissipate. Plus, you are constantly bombarded by radiation that degrades silicon over time. And if a chip breaks in orbit, you can't exactly send a technician up a ladder to swap it out.
Right, and the sources totally acknowledge this as a critical vulnerability. I mean, manufacturing defects and radiation will inevitably cause early life chip failures.
So how is this actually viable?
Well, their engineering strategy relies on using software to solve a hardware problem. First off, they are doing extensive pre-deployment stress testing on Earth.
To catch the weak chips before they launch.
Exactly. Catch the bad silicon before it even gets loaded onto a Starship.
Okay.
But the real mechanism is distributed computing. If a compute node gets hit by a solar flare and fails in orbit, they use their existing Starlink fleet management software to instantly reroute that computational load to other satellites.
Oh, I see. So the network is essentially self-healing.
Yeah, instantly.
If a cluster over the Atlantic goes down, the software just shunts the processing demands to satellites over the Pacific.
Right, preventing cluster-level downtime entirely.
It's brilliant engineering. But here's where it gets really interesting. Because building a self-healing orbital AI network requires a staggering amount of capital.
Staggering is the right word.
And when you look at the actual financials in the S1, the math gets brutal.
The cash burn is historic. So in 2025, SpaceX posted total revenue of $18.7 billion.
Which sounds great on paper.
It does. And if you look at their adjusted EBITDA, it sits at a relatively healthy $6.6 billion. But, EBITDA is a heavily massaged metric.
Right.
It completely ignores the massive costs of capital investments and depreciation.
Exactly. Because when your business model involves literally blowing up experimental multi-million-dollar rockets in Boca Chica and constantly replacing degraded early-generation AI chips, those aren't just like one-off accounting quirks.
No, those are your core operating costs.
Right. And that depreciation drags their $6.6 billion EBITDA down into a staggering JAP net loss of $4.94 billion for 2025.
Yeah, nearly $5 billion in the red.
And the bleeding is accelerating. I mean, in just the first quarter of 2026, they posted another $4.28 billion net loss.
Yet, despite hemorrhaging almost $5 billion in a single year, the market priced them at an IPO valuation of roughly 94 times their 2025 revenue.
Which is insane. Imagine buying a house for nearly 100 times your annual salary, based purely on the hope that you might invent a machine that prints gold in the basement.
That's a perfect way to look at it. That's the exact premium investors are paying. Because to put that into perspective, an analysis of the 5 largest U.S.-listed technology companies shows them trading at an average revenue multiple of about 12.2 times.
12.2 versus 94. So valuing a company at 94x current revenue is like paying for a century of flawless execution up front.
Basically, yeah.
You are buying the stock assuming not a single Starship explodes on the pad, not a single terrestrial grid manages to solve its power issues, and no competitor emerges for decades.
And if you break down the business segments, you see exactly where the capital is bleeding out.
Okay, let's look at the breakdown.
So Starlink, their connectivity segment, is actually a highly profitable engine. It generated over $7.1 billion in adjusted EBITDA.
Okay, so that's the cash cow.
Right. But the space segment is deliberately operating at a loss, sinking over $3 billion just into Starship research and development.
Which makes the AI division the true black hole on the balance sheet, right?
Ugh, massive black hole. The AI operations posted an operating loss of over $6.35 billion in 2025 alone.
Wow.
It is consuming every single dollar of Starlink's profits and then requiring billions more in debt and equity just to sustain its physical build-out.
So you have a company incinerating billions of dollars, betting its entire future on a completely unproven orbital compute model.
Yep.
In a normal public market environment, institutional shareholders would demand board seats, oversight committees, and, strict financial milestones.
They absolutely would.
But the S1 reveals a corporate governance structure that essentially makes that impossible.
Yeah.
Let's talk about the autocracy here.
Yeah, the governance risk is huge.
Right.
Prior to the listing, Elon Musk held roughly 42% of the equity.
Okay.
However, through a dual-class structure of Class B supervoting shares, which carry 10 votes per share, he controls roughly 85.1% of the voting power.
Right. And that kind of supermajority control triggers NASDAQ's controlled company exemption, which means SpaceX is entirely exempt from standard corporate governance mandates. They don't need a majority of independent directors on the board, and they don't even need an independent compensation committee.
But the governance goes much deeper than just board composition. I mean, SpaceX recently reincorporated from Delaware to Texas, specifically to leverage these newly established Texas business courts
Which are structured differently.
very differently. These courts were designed to rival Delaware, but they have shown a much stronger leaning toward enforcing arbitration and, frankly, deferring to corporate boards.
So what does that mean for an average shareholder?
Well, the prospectus explicitly states that if you buy a share of SPCX, you irrevocably waive your right to a jury trial.
Wait, really?
Yes, and you are prohibited from participating in class action lawsuits against the company. Every dispute goes to mandatory arbitration.
And the threshold to even force a shareholder proposal onto a ballot is astronomical. I read that the rules require a shareholder to hold at least 3% of the company's outstanding shares.
Which doesn't sound like much until you do the math.
Right. At a $2 trillion valuation, an investor needs $52.5 billion worth of stock just to suggest a change in direction,
It's basically a fortress.
which puts institutional investors in an incredibly difficult position. If you're an institutional investor like a massive pension fund, you are legally mandated to act as a fiduciary for your retirees.
Right.
Why on earth would you agree to hand over your money while stripping yourself of every standard legal protection?
It is creating massive friction in the institutional world. The sources outline this heated debate. Supporters of this controlled company structure, they argue that colonizing Mars and building AGI are not projects that fit into quarterly earnings reports.
Sure, they are multi-decade endeavors.
Exactly, with extreme technical risks. So they argue that highly concentrated decision-making protects the company from short-term activist investors who might, try to strip the company for parts when the R&D costs get too high.
But the pension funds are pushing back hard on that. The sources actually include a joint letter from the New York State Common Retirement Fund, CalPERS, and the New York City Retirement Systems.
Managing over $1 trillion combined.
Right. And their argument is that this level of concentrated power breeds a severe lack of accountability. I mean, if Starship faces a multi-year delay, or if those orbital AI servers just fail to commercialize, there are zero effective checks and balances to course correct.
None.
They are warning that this structure could plunge a $2 trillion company into an unmanageable governance crisis if they stumble.
Which brings us to the ultimate paradox of this listing.
Let's hear it.
We have a wildly ambitious technological roadmap, but we also have an $8 billion cash hole and unprecedented governance risks.
Yeah.
So how does the market actually calculate a price for this? Well, Morningstar conducted a deep dive fundamental analysis utilizing a probability-weighted discounted cash flow model.
Okay, let's break down how that model works because it's crucial. Morningstar isn't just picking a number out of thin air, right?
No, not at all.
They are evaluating 3 entirely different timelines for the company and blending the valuations based on how likely they are to actually occur.
Precisely. If we connect this to the bigger picture, Morningstar assigns a 43% chance to what they call the no-go scenario.
Okay, what happens in that timeline?
In that reality, Starship faces severe regulatory or technical delays, and the orbital data centers fail to prove commercially viable. And in that scenario, the stock is worth just $41 a share.
Okay.
Then they give a 50% probability to a minimum viable product scenario where Starship works, but the AI integration is slower than projected. That values the company at $70 a share.
And then there's the moonshot scenario.
Right. They give only a 7% chance to the moonshot scenario.
Wow.
This is where everything goes perfectly, rapidly reusable starships and commercially dominant orbital data centers.
And what's the price there?
Only in that highly optimistic 7% reality does the valuation reach $154 a share.
Which is roughly where the IPO priced. So when you blend those probabilities together, Morningstar's fundamental analysis values SPCX at just $63 per share.
Which is a massive 53% discount to the initial IPO price of $135.
But here's the paradox. The stock didn't crash to $63 on day one.
No, it didn't.
It popped 19%. It closed over $160 a share. So who is wrong here? Are the fundamental analysts missing some hidden value? Or has the market entirely detached from reality?
It is neither, actually. What you're seeing is the overriding power of structural market mechanics.
The index-driven liquidity.
Yes. The value of SPCX right now is being driven far less by the fundamentals of rockets or the probabilities of AGI, and almost entirely by liquidity. It all comes down to the public float.
Okay, so just as a reminder, the public float is the percentage of a company's total shares that are actually available to trade on the open market.
Right. Everything else is restricted.
Yeah, locked up by the founder, early venture capitalists, employees. And SpaceX has an incredibly tiny public float of just 4.3%.
Historically, major indices like the NASDAQ 100 required a company to have a minimum public float of 10% alongside a seasoning period of trading before they can be added to the index.
But NASDAQ changed the rules.
Right. Capital market analyses show that NASDAQ instituted new fast entry rules just before this mega IPO. They completely eliminated the 10% minimum float requirement.
And under these new rules, SpaceX's tiny 4.3% float is given a 3x multiplier for index weighting purposes.
Exactly.
So the algorithm treats the company as if it has a nearly 13% float.
And that multiplier is what triggers the massive price distortion. When a company of this size is fast-tracked into a major index, passive funds like massive ETFs and mutual funds are structurally forced to buy the stock.
Because tracking error is the ultimate sin in passive management.
Oh, absolutely. If an ETF underperforms the NASDAQ 100 because a portfolio manager refused to buy an overvalued stock, that manager gets fired. It is algorithmic compliance.
So they literally don't care if the revenue multiple is 94x.
Whoa.
They don't care about the mandatory arbitration clauses or the cash burn. If the index rules say SpaceX is heavily weighted, the algorithm just executes the buy order at whatever price the seller demands.
And the scale of this forced buying is staggering. The sources estimate that between $15 and $20 trillion of passive fund capital are benchmarked to indices that are fast-tracking SpaceX.
It creates a severe liquidity squeeze. It's like a game of musical chairs, where a massive crowd of billionaires is forced to play, but there are only 4 chairs available.
That's exactly it. It's a mechanical bottleneck. You have trillions of dollars trying to force their way through a 4.3% float window.
Wow.
So price discovery in the early days of this stock is no longer an evaluation of Mars colonization or AI thermal dynamics. It is entirely a supply-demand imbalance.
So what does this all mean for you? I mean, the $2.1 trillion valuation of SPCX is perhaps the ultimate modern financial paradox.
It really is.
On one hand, you are looking at humanity's most ambitious physical infrastructure project. They are attempting to build the literal physical rails of future intelligence in orbit.
Yeah.
But on the other hand, you are looking at a stock that is completely detached from fundamental value. It's being artificially propelled by index liquidity algorithms, a tiny float, and a corporate structure that strips you of all accountability.
It forces us to ask a really difficult question about the state of the markets. Are public exchanges still functioning as weighing machines for long-term fundamental value? Or have they simply become plumbing systems that route passive capital based on arbitrary index multipliers?
That is the question that will define this next decade of investing. But before we wrap up, there is one final provocative detail buried deep in these sources that shows where the chess pieces might really be moving.
Yes. Amidst all the massive figures regarding gigawatt data centers, reusable starships, and orbital hardware, there is a distinct line item regarding a software company called Cursor.
Cursor, right.
SpaceX has entered into a $10 billion collaboration with them. But embedded within that agreement is a staggering $60 billion option for SpaceX to acquire Cursor outright.
$60 billion.
And if SpaceX doesn't exercise that option, they have to pay a $10 billion breakup fee.
Which is fascinating because Cursor is an AI coding platform. It's pure software. So why is the ultimate physical infrastructure company, a company focused on bending metal, pouring concrete, and launching silicon into orbit, willing to lock up tens of billions of dollars for a software platform?
It points to a massive, largely unpraised secret in their overarching strategy. SpaceX isn't just satisfied building the rockets that deliver the hardware.
Right.
They aren't just satisfied manufacturing the terawatt chips or powering the orbital data centers with solar energy. They are quietly laying down the capital to potentially own the foundational software layer of AI coding itself.
So if AGI is going to be writing its own code in the future, owning the platform where that code is generated means you own the foundational language of the future.
Exactly. It is vertical integration on a scale we have never witnessed in modern capitalism.
From the solar panels capturing energy in space, straight down to the syntax of the code on the screen.
It really suggests that the $2.1 trillion valuation, despite all its mechanical distortions, might be pricing in a monopoly that hasn't even been fully articulated yet.
Wow. So as you watch this play out, keep questioning the fundamental value behind the market's biggest numbers. Look past the hype of the rocket launches and look closely at the float multipliers, the governance structures, and those quiet $60 billion options hidden in the footnotes. Thank you for joining us as we explored the tectonic shift of the SpaceX IPO. Let's see how long the needle stays off the chart.